All right, so today I wanted to make a video on my 3 favorite Canadian dividend stocks. And one thing you will notice about these stocks when I get into it here is that none of them have very high dividends. Of the 3, the one I have up here, Go Easy, has the highest dividend at about 3.5%, right? So a very important thing when it comes to dividend investing that I don't think enough people understand is that the existing yield it should be meaningless to you, right? For the reason being is that dividend growth will outperform dividend stocks over the long run, right? And I made several videos going over that, and the data is just really clear on that. And again, a lot of people say, oh, what if you want income? But again, it's funny because a lot of those people are like literally in their 20s or 30s, right? So the vast majority of people that say that really doesn't make sense to me. So again, dividend growth is where it's at. And again, if you want an example of that, let's use Go Easy here, right? So again, currently is a 3.48% yield. Again, payout ratio about 33%. Again, let's look at the historical yield on cost, right? You go back 10 years, right? You go back 10 years, you would have a 38% yield on cost, right? Again, are there any current dividend stocks that have a yield anywhere close to that? No. Right? Now, again, they're growing their dividend 33% a year. Are they going to be able to maintain that over the long run? Definitely not. But again, they're still going to grow that nicely, I think, right? So again, Go Easy is a kind of a subprime lender, for lack of a better way of putting it. Again, only a 1.74 billion dollar company. Again, I still think they have room to grow. Again, they have an earnings yield of 10%, right? So they got a lot of room to grow that dividend. They have actually came down quite a bit recently. This is a company that, again, as recently as August, they were $133. They're down, what are they down since then? They're down about 20%, right? So again, this is a company that's kind of been all over the map recently. I was lucky enough to buy right near the yearly lows back in May. I'm still looking really good on those shares. I'm very happy with that. Again, you could make the one concerning thing about this company, I think, might be regulation. I think it might be the government, honestly, regulating this company probably is my biggest concern. But again, if you look at one thing, people's penchant for spending money they don't have, very, very concerning nowadays, and I think companies like this are going to benefit from that. So again, the next one here is going to be EQ Bank. Again, I've talked about all of these before. I made videos about all of these before. Again, EQ Bank, obviously a bank. Again, $2.8 billion. Again, that's still what, small cap, probably bordering on mid cap. Again, very, very good company. Again, they've kind of corrected a little bit since their high also in August. They're down about 12% since then. But again, they are up very nice on the year. Again, this is a company that was, about $57 at the start of the year. They're up 28% on the year. Again, I was lucky enough to buy a handful, maybe about 10 shares, roughly, maybe a little bit more. I don't even remember. Honestly, below 50, right? This was over a year ago. So again, that's looking very good. We're up over 50% on that. Again, you see the current yield, 2%, right? So another one of the reasons why dividend growth is better than straight up dividend investing is with higher rates, the dividend like the typical dividend companies or dividend ETFs aren't going to be as attractive, because if you can get 5-6% on a bond, you're going to be less likely to invest in a traditional dividend stock that has a return of 5-6%, right? Because if you can get that guaranteed return, why would you invest in the stock, right? So again, you got to keep in mind that the old traditional dividend stocks, especially the utility ones, the consumer staples ones, they're going to suffer in a higher rate environment, right? You want dividend growth. Again, let's give another example of that, right? So again, current yield is about 2%, right? But if we look at their growth rate, again, payout ratio only 17%, just below 17%, right? So they're going to be able to grow that dividend a lot in the future. Again, if we go back 10 years, again, yield on cost about 8.5%, right? So again, higher than the vast majority of dividend stocks right now. So again, this is another one of my favorites here. Again, I very much like this company. I think it's got a lot of, it definitely has, there's some headwinds. I'm not going to say there's none, but I think most of this is going to be tailwinds because, again, they have better savings accounts rates with everything being online. The fees are lower. They got better services. And again, as the boomers age out, people are going to be more and more willing to do stuff online, right? So again, I think it has definitely more tailwinds than it does headwinds. The last one here, honestly, this in some ways this is my favorite one because this is Alimentation Couche-Tard. Again, they are a basic retail property owner. Again, they're by far the largest. Again, $69 billion company. Again, they're also up very nicely on the year. They're up about 20%. Again, I picked up a handful of shares, quite a few shares at about $65, $66. Again, only up maybe 10%, 7-8% on that. But again, you notice the dividend yield is not even 1% on this company. Again, earnings yield 6%. Again, I'd like it to be a little bit higher, but again, let's look at the growth of this company over time. Again, payout ratio. Again, look, 13%. If we go back 10 years, again, what's the yield? 7% yield on cost. So again, these are the kind of companies that you want. Right? Look at how well this company is growing. Right? If we look at the cash flows here, again, look at the free cash flow has. I mean, if in 2013 it was 624 million, now it is 2.5 billion. Right? So that's what, like a 4x, 5x roughly. Again, those are the kind of companies you want, right? That are growing very, very nicely. Again, look at the company. Look again, nice financial health. The growth is solid. The management is very good. The profitability is decent. And again, it is a little bit above its historical valuations, but again, not by a lot, just by a tiny bit. I'm not concerned. Again, I honestly think you can dollar cost average into every single one of these companies. Again, Alimentation Couche-Tard probably is my favorite because I think it's the safest. But again, not only is it safe in my mind, it's growing very nice. Like, this is a company that I think is both safer and will outperform the market over the long run, which is exactly what you want in a company. Again, look at 10 years. They have grown 785%. The S&P 221, right? Let's go back. Let's go 5 years, right? Let's go 5 years just for curiosity's sake here. 138% S&P 63. Let's go even 3 years just for curiosity here. Again, S&P 32, Alimentation 56. So again, this is a company that always outperforms the market. And again, I think it's going to do it in a safer manner. Why would you not want a company like that? So again, like I mentioned, of the three, this is definitely my favorite because I think it's the safest and I think it's a home run to outperform the market over the long run, right? And again, with that dividend growth, they're going to grow their dividend probably 15-20% per year over the next decade. That means that you're going to have a dividend that is, what, 3 to 4x what it currently is, right? So you're going to have a 3-4% dividend yield on cost for a company that's going to outperform the market. Like, who in the right mind would not want that, right? They're expanding to other countries, to other areas. Like, again, I think that honestly, this is, if I were to pick 3 companies, 5 companies in the whole stock market, this would be one of them. Even if I was to pick 3, this probably would be one of them. That's how much I like this company. So anyway, again, as far as Canadian dividend plays go, these are definitely my favorite. I think CN is another play in there. As far as more growth companies go, I do like Constellation Software, but again, they're expensive right now. Again, honestly, on my top 5 Canadian companies, that's probably them. But again, as far as pure dividend plays go, these are my top 3. So anyway, if you liked the video, hit that like and subscribe. Please like, comment, all that good stuff, and stay tuned for more.